A Roth IRA with $5 billion in it. How does that happen? We'll talk about that on the program this week, along with, we're going to be joined by one of the fellow certified financial fiduciaries here at Nelson Financial Planning, Garrett Fields, and talk about how to really understand how your income and expenses work along with your balance sheet. Of course, the balance sheet concept goes directly to what your net worth is and how you might improve that. So welcome to Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. Recently named not just one of the top 25 financial planning podcasts on the World Wide Web, but thanks to the folks at Wealth Magazine, we are one of the top 20. So we're kind of moving up in the ranks. My name is Joel Garris. I'm a certified financial planner, certified financial fiduciary with Nelson Financial Planning, where our team of certified financial fiduciaries stands ready this week to help you change your life with a successful and cost-effective financial plan. So one of the interesting things that's been happening is that investors as a whole have become more optimistic, particularly over the course of the past few years. It's sort of an optimistic time in general, right? We've got the country opening up, people are traveling. Good luck trying to, get a passport these days. I don't know if you saw the Wall Street Journal article, but the reality is that it's very difficult to get a passport these days because of the demand that is approaching everything in terms of travel. We just last weekend dropped my youngest son, Connor, off to go on a study abroad program in Ireland, and the things that you have to do ahead of time, it's still a little tricky to navigate, that is for sure. But that's a sign of optimism, right? People getting out, people getting re-engaged, and certainly the markets have reflected this optimism, not just over the course of the past year, but really over the course of the past 3, 4, 5 years. And that's all great, but the problem with that is that is producing a bit of a false set of expectations in people these days, and maybe needing a little bit of perspective, if you will. A recent survey of individual investors really kind of brought this issue to light, if you will. And what it found was that investors expect to earn an average of 17.5% per year after inflation. Now, just to stop and think about how crazy that is to have that expectation, that's more than twice, almost triple what the long-term return has been for U.S. stocks since 1926. The average there has been about 7.1%. Annually after inflation. It's more than 3 times if you put the impact of inflation and taxes in on that. So the expectations and what investors are feeling now is a really kind of a off base, if you will, versus what the reality traditionally is. And that's just not U.S. investors. The survey actually surveyed 8,500 different investors in a total of 24 different countries, and equally optimistic in those other countries. Of course, here in the U.S., we're more optimistic, so we were like the top of the optimism survey. But pretty much in all of these other countries, investors also were relatively optimistic, and that optimism doesn't just extend to individual investors. It actually is hitting the C-suite. If you look at the survey of CFOs, chief financial officers, this is a Federal Reserve survey, and the CFOs expect the S&P 500 to return 8.4% per year over the next 10 years. What's interesting about that statistic is that's a survey as of the end of May. A few months prior to that, in December, so 5 months prior to that, the expectation was 6.8. So it's kind of one of those phenomenons that are human in nature. The notion of this recency effect that it has on people's perspective, and ultimately changing our perspective of what really is possible. And certainly the markets have attributed to that recency phenomenon that is perhaps creating this investor optimism. One of the other metrics out there, there's the Yale study, their confidence index, which tracks how many people expect positive returns in the next 12 months, is at the highest level since 2012. So again, a huge amount of optimism, and certainly the market has gone along with that optimism. If you look at the S&P 500, as of the course of just this past week, the 3-year annualized return was just approaching 18%, 17.98. The 5-year return was 17.28. So no wonder investors sort of think, oh, well, 17.5, that's that's like normal. And the problem is that reality is quite different. They did an analysis of 3,800 stocks and ETFs that have traded continuously over the course of the past 10 years. And what they found is that only like 14% earned that kind of return of that 17.5% or better. What was even more interesting about the analysis of this broad cross-section of stocks and ETFs is that 22% over that same 10-year period of time actually earned a negative rate of return. So you were 50% more likely to own a position if you just get randomly selected positions across that spectrum. You were 50% more likely to own something that actually had generated a negative return rather than that 17.5%. So the issue is really twofold, right? You've got that recency issue, which is a psychological phenomenon that our minds think what has happened in the most recent past is in fact what's going to happen in the future. And so I think that recency phenomenon is certainly clouding investors' perspective, and understand just how concentrated the performance has been in a handful of sort of household names, right? I mean, Tesla, obviously the biggest performer over the course of the past 10 years. I think their annualized return over the past 10 years is like 59% per year. I mean, just crazy numbers. But also when you think about Amazon, Netflix, particularly over the past 10 years, they've also seen a high level of performance. So when you think about that and those popular names and how concentrated it is, and we've certainly talked about this in prior programs, the concentration of the FANGs and how much it's delivered in terms of the performance. But understand the risk, folks, right? If you think that you're going to make 17.5% when history says it's more like 7 or 8%, then you're setting yourself up for failure. Don't count on an excessive level of a return to ultimately repair the damage that perhaps you've done to your finances along the way. That's why these next couple of segments are so important, because we're going to talk a little bit about that perspective of your overall finances, whether it be balance sheet, whether it be income statement, things like that. Because if you set those unrealistic expectations, thinking that that's going to somehow, sort of catch you up or things like that, it doesn't eliminate the need to plan appropriately and to avoid sort of that false sense of security that can come if you're thinking you're going to make that kind of money and then you're taking out an excessive amount of money out of your accounts. It's ultimately going to end badly. So we're going to be joined in the next segment by our associate Garrett Fields, certified financial fiduciary there at Nelson Financial Planning, and we're going to talk a little bit more about how to kind of address this net worth income statement item for you personally. Coming up next here on Dollars and Cents with Joel Garris of Nelson Financial Planning. This segment of the program, we're going to talk a little bit about how best to look at your fundamental finances, and for that we think that it's good to utilize the format of a balance sheet and an income statement. We're joined with us today on this segment with our associate Garrett Fields, a certified financial fiduciary at Nelson Financial Planning. He specializes in helping folks really sort of understand what their cash flow looks like, sort of that money in, money out, and sort of that overall financial picture, their assets, their liabilities, and things like that. So we welcome Garrett to the program. How are you this morning?
I'm doing good. Thanks for introducing me.
Well, excellent stuff. Tell our audience a little bit about yourself.
Sure. So obviously my name's Garrett Fields. I work at Nelson Financial Planning. I actually started here as an intern. I've been here for about 5 years. Since I've been here, I've gotten my Series 7. I'm also a certified financial fiduciary and gotten my insurance license.
Well, and I can say, we've had some great success with our internship program out there at UCF. So we've got you that came through our internship program, our latest addition to the team. Chet has what started out as an intern. Christina, even, who's been with us now for more years than she wants to share on air, was started out as an intern, and of course Kristen on the CPA, who joined us last a couple of weeks ago on the program to talk some taxes. She also has been was an intern as well. So good success for internship. That's where we encourage all employers out there to, take an opportunity to reach out to the next generation and give them an opportunity to try and learn something from your organization as well. So what kind of motivates you in terms of this line of work? Because as a young college grad, 5 years ago, when you're kind of thinking about, okay, where am I going to go? What motivated you? What attracted you to this industry, if you will?
Sure. So Einstein called compound interest the eighth wonder of the world, and that's absolutely correct. So we're in a unique situation and a unique job where we can wake up every single day and we can actually help people better their lives and change their lives through compound interest. And this is a great place to do it. We talk to everyone and we try to help everyone we can every single day. That's kind of what gets me up in the morning.
Well, that's certainly unique about our operation, whereby we don't have any account minimums or anything like that. So we really are kind of here to help folks make a difference in their lives. So that's a good comment, and certainly something that motivates even me now, 20 years later. I know you're a big fan of Dave Ramsey, so tell us a little bit about why you kind of like his thoughts and approach.
Yeah, so us and Dave Ramsey share a lot of values. He's very anti-debt, which we love, and he's also against borrowing to get out of debt. He's very much, these are your personal finances and this is your responsibility. If you don't like the financial picture you're in, it's up to you to change it. And we very much stand by that.
Yeah, absolutely. I mean, your finances are your finances, and the biggest issue, and I think this is something that everybody can relate to, biggest issue out there these days is the amount of debt that folks have. How big of a drag that can have on your financial situation can certainly be tremendous. So when we start to have that conversation with somebody, and whether they're just starting out or whether they're approaching retirement or even in retirement, what are the sort of the two primary documents that we like to utilize in that situation?
Sure. So the reality is that people in their finances are very similar to a business, and the two primary documents that a business uses are an income statement and a balance sheet. So we think it's appropriate to use those two statements as well.
Certainly, if it's good for corporate America, it's probably good for you personally.
Exactly.
So so what we also like to do, and when we do it, is it also, the beauty of those documents, your income statement and your balance statement, is those can really be consolidated down to a couple of pages, right? And so I like to talk about putting stuff up on the fridge. Of course, fridges these days, they're not magnetic anymore because they've all gone kind of with the cheaper material. But
some even have screens on them.
Some even have screens on them. Yeah. So you could create a picture and then put it on the screen.
You can email it to your fridge and it'll be up on your fridge.
Okay, problem solved. So that's the difference in perspective. I'm still thinking of magnetic fridge, and you're thinking the one that's got the screen on it. So, but anyway, so yeah, you can do it that way. But the beauty of an income statement and a balance statement is that those really are effectively one-page documents. And our perspective is, and we've certainly seen folks come in and share with us, these 70-page computer-generated reports with just a bunch of ridiculousness that might have cost them, $2,000, $3,000, $4,000, $5,000 even, and that doesn't really give somebody a document that they can really work with, that they can really embrace, if you will.
Well, yeah. So two things on that. Whenever we use those two documents, is one, ours is 2 pages. Now, granted, that is front and back. But the way that we do it is we don't use the numbers that you think you owe or you think you have. We like to use concrete numbers based off statements. And that really does two things. So many times, for example, we see people coming in where student loans. They think they started out with $20,000 as student loans and they've been putting $100 towards it a month. Well, and so they think they're paying it down. Well, the reality is that the interest rate on them was $300 a month. So they come in telling us, oh, I paid down my student loans from $20,000 to $15,000, where in reality it's gone up from $20,000 to $30,000. Same thing on the other side. They opened up an account 20 years ago and put 20 grand into it. They assumed that that money was invested, so now they think the account's worth $60,000 or $50,000, where in reality it's been sitting in cash and it's still only $20,000.
Yeah, it's so important to kind of get really down into looking at your actual statements. And what we see people really struggling with these days is that oftentimes, you sort of click the button or you enroll online and things like that. And then the statements wind up getting sort of generated by email. So you no longer get the hard copy, and then spam filters and all that kind of stuff. You're like, where'd my statement go? I have no idea where it is.
And it never gets seen. You never really know how much you truly have, and you never really know what you own or what's going on.
So let's talk about sort of that first document that we always kind of turn to, and that's the balance sheet. What's on that, and kind of how does that ultimately work for a person that's listening and trying to say, okay, well, how can I kind of start to figure this stuff out a little bit? Tell us a little bit about what's on that balance sheet. Sure.
So the balance sheet is essentially your assets versus your liabilities. Now you have a couple different assets and a couple different types of liabilities, short-term, long-term, on both sides. But really at the end of the day is you can take both of those and you can subtract them against each other and you can get your net worth. And it's also very good to take a look at because different liabilities kind of do different things. So for example, credit card debt, those have interest rates of upward of 25%. So it's good to go ahead and just pay those off as quickly as you can. And on the other side, you might have a mortgage. And mortgage rates right now are in the 3s or even possibly lower. So those don't necessarily need to be paid down as quickly. But whenever you put them on a piece of paper, it kind of changes the perspective and it makes you feel more responsible for what you actually have and more responsible for your own personal finances.
Yeah, that's a great perspective because just sort of start to pull those numbers together. And so when you think about assets, we always like to think of them much like you would on a balance sheet. What's the most liquid asset all the way down, to what's the least liquid. So the most liquid would typically be cash. And then, least liquid would be like real estate, those kinds of things. So not just to think about it just as, okay, what I own, but also what's the nature of what I own in terms of liquidity. Because after all, when you're retired and you want income, you got to have that liquidity as well. And then the same thing on the liability side, what's that short-term debt, if you will, credit card debt. To your point, that's the piece that you got to kind of focus on, the short-term debt. The longer-term debt, which would typically have a lower interest rate, that's the one that you can sort of pay a little bit more so over time. So with that perspective, what are some of the ways that for someone to we're going to talk about some of the ways in which folks can improve their balance sheet. So if you can stick around for the next segment here, we're going to start that off with our associate Garrett Fields here at Nelson Financial Planning. We're going to start that conversation off with how do you improve that balance sheet, that net worth number. Coming up on the next segment here on Dollars and Cents with your host Joel Garris of Nelson Financial Planning. So we're going to talk about some of the ways in which you can improve your overall financial picture, thinking about it through the perspective of the age-old corporate document of a balance sheet. We think those statements that a corporation typically uses, the balance sheet, the income statement, are great statements to apply to your personal life. That's something that we do here in the office when we're kind of visiting with people and helping them sort of get track of what their overall financial picture is. My name is Joel Garris. I'm a certified financial planner, certified financial fiduciary with Nelson Financial Planning. We're joined again in this segment with our associate Garrett Fields, also a certified financial fiduciary at Nelson Financial Planning. So Garrett, tell us, we were talking about the balance sheet, assets, liabilities, assets minus liabilities obviously equal your net worth. what are some of the ways in which somebody can really look to improve their overall balance?
Sure. So the easiest way is to start saving more money. That goes on the asset side, that builds that side bigger, which builds your net worth. Also, having some liquidity and having some cash on the asset side is a huge way to build your net worth, because is what ends up happening is you end up overspending 1 month, and that's okay, that's normal, but you overspend 1 month, and in order to keep that extra money off the credit cards, you're able to put it, you're able to pull from your savings account and pay off that bill. And as we talked about earlier with credit cards, those interest rates can be upwards of 20%. That can start to rack up really, really fast. So having some cash and having some liquid assets on the side, that can really keep you from really destroying your whole financial picture.
Well, and certainly having that emergency savings account. I mean, we can't emphasize that enough. You just look at what's gone on over the past year and a half with the pandemic, and a lot of people having their jobs, just completely, ripped out from them. And the single biggest way you can very quickly undermine your net worth, your balance statement perspective, is if you don't have that emergency savings, right? Then you got to go to the credit cards. The credit cards have high interest rates, and so ultimately, then that winds up sort of really having a cascading effect pretty quickly on you, which I guess also then leads us to sort of another way that you can improve the picture, and that's the liability side, right?
Paying off your short-term liabilities, those normally have the highest interest rates, and those are going to be the ones that rack up the fastest. And so by paying those off as quickly as possible, that's going to help you, especially in the long run.
Well, and another way to improve the asset side is something that you kind of pointed out in the previous segment, which is oftentimes people sort of forget about some accounts or maybe an old 401k or what have you that's out there, and then lo and behold, they find out, oh, it was sitting in cash all this time. So it's important to also sort of know the asset allocation of the assets that you've got.
Exactly. Not only knowing the asset allocation, knowing what you have, but knowing exactly what you're invested in. I mean, we try to go over in detail what our clients are invested in, because we want them to be knowledgeable, and we want them to be confident, and we want them to know what they're invested in order to get a better rate of return.
Right, because if you get a better rate of return, then obviously the asset side is going to be improving as well. So those are some of the things, if you think about your net worth, a person's net worth, related back to that balance sheet concept, those are some of the things that you can really do to sort of improve the asset side, decrease the liability side, and ultimately improve your overall net worth. So let's shift gears to sort of that other sort of important document, which is the income statement. So let's set the table first. What's sort of the fundamentals of the income statement, if you will?
Sure. So the income statement is money in, money out. It starts with how much money you make a month, and then we subtract all your expenses every single month, and then what you have at the end is hopefully positive, and that's how much you're able to save.
Problem if it's not.
Exactly. Yeah. We need to make some changes if it's not. But the nice thing about the income statement is you put all of your expenses down. This includes, the $5 Starbucks expense that you do every single day. And the thing with this is whenever you put, okay, I go to Starbucks every single day and I spend $5 every single day, every time you swipe the credit card, that might seem like a small amount. But whenever you put it down on paper and you start to actually take a look at it, a lot of times people are shocked as to how much they're spending and where.
Yeah, the exercise of tracking your expenses, boy, that's a traditional one. We were talking a little bit about Dave Ramsey in the prior segment. That's certainly something that he advocates as well. And just the notion of sort of sitting at the end of the month and really tracking it and seeing those totals it can often surprise people at where the money is going. That's for sure. The other concept that I think folks sort of forget when they think about saving money is they think about, okay, I got money in, I got money coming out, much like the income statement shows, and then whatever's left over, that's the part that I'm gonna save, and that's probably not the right perspective, is it?
No. So what you need to do first is you need to what's called pay yourself first, which is determine how much you want to invest or how much you want to save at the each month, and then whatever's left over, that's what you have the ability to spend. Far too many people do it backwards, and they try to spend first, and then whatever's left over they end up saving. But the reality is that you end up spending it all.
If you're always saying this is the thing that I'm going to do at the end, chances are at the end there's not enough left over to do what you want to do. So that kind of goes to how you improve your overall position when it comes to income, your income statement, right? Little changes can certainly make a lot. If you're keeping track of expenses, then you can see where you can make some adjustments.
Oh, absolutely. I mean, like we were just talking about, I don't mean to beat up on Starbucks too much, but, $5.
Yeah, Dunkin'.
Yeah.
Okay, or Krispy Kreme.
Well, $5 a day on coffee, that ends up being just under $2,000 a year. And so, whenever you start to look at it like that's an enormous amount of money that you're spending on coffee every single day. And whenever you spend $5 a day, it doesn't seem like much, but whenever you get to the end of the year and you see a $2,000 bill or $2,000 going towards these coffee corporations, it's a big number.
It's not, and the good news is, as an investor, we typically run Morningstar analysis on our client portfolios, things like that. And one of the names that we see is Starbucks. So if you're an investor, it's a good thing. If you're trying to get on top of your finances, that would be the place to kind of think about, because it's those types of little changes, right, that can make a big difference over time. I know you did a video for our Instagram channel, our Instagram audience, and you talked a little bit about that. Why don't you kind of share the nuts and bolts of that, because that is pretty dramatic of the importance of starting early, even with a small amount. And so I'll let you talk more about that.
Sure. So I actually have the numbers right in front of me, and far too many people think, I don't have enough money to start investing, or I'll start investing around my 40s or 50s whenever I'm actually making money. Well, the reality is that you don't actually need a lot of money to get started. And the most important thing when you invest is time. And so the example here is, let's say you have two friends. The first one starts investing at 18 and he invests $2,500 a year up until age 27, and then he stops. So he had a total investment of $22,500. Now, assuming he gets a 10% rate of return, by the time he turns 65, he's going to have $1.5 million. Now, he only invested $22,000, and that sounds like a lot, but again, that was over 10 years. Now, his friend started at age 27 and invested through age 65. And again, he invested the same amount of money a year, $2,500, except because he invested over a longer period of time, he invested $97,500, so almost 4 times more. Well, the reality is that he only ended up with $1 million. And the reason for that is because the first friend that started at age 18, he got in 10 years earlier. So compound interest, like we talked about in the previous segment, Einstein said it was the 8th wonder of the world, that was able to take a hold that much faster, and he ended up with $500,000 more, even though he invested a fourth of what his friend invested. Some
pretty dramatic results, which I think really, really underscores the importance of getting started. And maybe you're not 18, maybe you're 28 or 38. The reality is that the sooner you start, the more you can at least give yourself the advantage of time. I think far too many people is the old adage of it's not about timing, it's about time in.
Exactly. And I mean, the reality is that this is $200 a month that he was doing. It's not that much. Most people are able to do that, but they don't think that that's going to make a difference. And in the reality, the math says that they're wrong. It's going to make a huge difference.
Thanks for joining us on the program this morning.
Absolutely. Enjoyed it.
We enjoyed it. Coming up next on the program, we're talking about somebody that has $5 billion, with a B, billion dollars in their Roth, how that happened and how it might actually wind up affecting you. Coming up next here on Dollars and Cents with Joel Garris of Nelson Financial Planning. So did you hear about this story about this individual that has $5 billion in their Roth account? There's this website, ProPublica. Maybe you've heard this story. And apparently ProPublica somehow, or at least that's what they're claiming, they somehow managed to get a hold of the tax return. I'm not sure how they did that, but they managed to get a hold of the tax return for a lot of high net worth Americans, and one of them involved looking at, or the analysis that they did involved looking at different types of retirement accounts that these individuals have, and they found, sort of the biggest example is a Roth account that actually has $5 billion in it, owned by a guy by the name of Peter Thiel. Well, we're going to tell you a little bit about who Peter is and how that came to be, because ultimately it's this kind of attention on retirement accounts that always sort of gets the political's attention. And ultimately, as they make changes to these accounts, they often say, oh, it won't, don't worry, it's not going to affect you. Well, the reality is that we often see where it does. So we want to get some of these concepts sort of on the table that are floating around as a result of this headline, but also been floating around for a number of years as well. So welcome back to Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. We're Central Florida's longest running radio program, coming to you on a variety of networks across Central Florida. We're also happen to be one of the top 20 financial planning podcasts on the World Wide Web. So make sure you check us out on your favorite podcast channel or social media channel of choice. Also have a YouTube channel as well, where you can kind of see the videos that we do on a regular basis. We were joined in the last segment by our associate Garrett Fields. He does a lot of stuff on Instagram that we encourage you to check us out on that platform as well. My name, of course, Joel Garris. I'm a certified financial planner, certified financial fiduciary with Nelson Financial Planning, where our team of certified financial fiduciaries like Garrett Fields stands ready to help you change your life with a successful and cost-effective financial plan. So who is this Peter Thiel guy, and how the heck did he wind up with $5 billion in a Roth account? Allegedly, underscore allegedly, because the folks at ProPublica, which is where all these headlines are coming out of, haven't really disclosed, well, wait a minute, how did you get copies of these tax returns for all of these individuals? Well, Peter Thiel is the founder of PayPal, and many years ago, right, when PayPal first started, the value of PayPal shares was like less than a penny. So what he did was he took a bunch of shares and put them into his Roth. At that point in time, you could only fund $2,000 into a Roth, but if the shares you're putting in are worth less than a penny, well, then you can contribute 200,000 shares of a particular company. And so consequently, that's what he did. And now, fast forward 30 odd years, that contribution has grown on a tax-free basis to now be worth $5 billion. And that entire amount of growth, because it's in a Roth, has been growing on a tax-deferred basis and will also be able to be utilized without any taxes whatsoever. Now, you can understand that gets the attention of the politicians. And remember, the important thing here is there's nothing illegal. No one's alleging any illegality in this transaction, because you can, in fact, put non-publicly traded company into a Roth as part of the contribution. That's part of the options that you have when you make a contribution. It's certainly a highly unique situation. It's kind of the 1 in a million or 1 in a billion type of situation that sort of played out for this individual, obviously turning into some pretty dramatic numbers. But needless to say, this type of headline, assuming that it's true, and that's the piece that everybody kind of can certainly question in terms of the disclosures that this particular website is doing, regardless of if it's true or not, it is catching the attention of the politicians, so that they're always kind of on the lookout for money, right? And we've certainly talked about this before. What happened 18 months ago, when the Secure Act passed, and remember, that passed in a bipartisan manner, that ultimately changed the rules on IRAs and how people inherit IRAs. And just to recap that, we've certainly spent a lot of time on previous shows and podcasts talking about this, but under the Secure Act, which passed in January of last year, as a beneficiary of a retirement account, it used to be that I had the rest of my lifetime to take that money out, which meant that it could grow on a tax deferred basis, and then it was only taxable as I took the money out. Now I must take that out within a 10-year period of time, and it's interesting, why they chose that 10-year period of time. Folks in Congress, they're crafty. Okay, got to give them that. The reality is that when Congress makes budgets, they look at revenue over the course of a 10-year period of time. So the 10 years was not some random number. That's in effect the period of time that they look at in terms of being able to generate revenue when they're kind of working on the budget. So this story that is now getting a little bit more traction really helps to underscore some of the things that have been on the table and some of the things that I think we could certainly see on the table. And some of them are going to be not really applicable to the vast majority of people, but others certainly are. So we thought it good to sort of get on the table some of the concepts that might be out there and how they might ultimately impact you. The first of which is sort of an account size restriction. There's a lot of folks talking about, well, if the retirement accounts get above a certain level, we're not going to allow you to either contribute more to them, or we're going to make you take some of that excess out over the course of each and every year, as long as that excess exists. And this was a proposal that originated back in the Obama administration. And obviously with this headline, it's causing a resurrection, if you will, of those kinds of headlines where if your accounts go above a certain level, in essence, you are forced to take some withdrawals because of those account size restrictions. The other thing that might very well be on the table is this notion of Roth conversions. Remember, prior to 2010, you were not allowed to do a Roth conversion so long as your income was above $100,000. Well, that's a pretty low level of income, particularly if you're trying to convert an IRA to a Roth. After 2010, that income restriction was eliminated, but that could certainly, we could certainly see that coming back. So if you're thinking about doing a conversion, it's certainly something that you want to be thinking about. One of our sort of guiding principles is make sure that you run the numbers, because oftentimes what we see is sort of when folks kind of run the numbers on, should I convert my IRA to a Roth? The amount of taxes that you've got to pay. Remember, you got to pay them all at one shot. You got to pay them all in one lump sum. You don't get to spread them out over a period of time. That really often bends the analysis back to, okay, well, maybe I'll leave everything well enough alone and not really do a conversion. The other item that I think is a high likelihood, so I think you could see a likelihood of a return of sort of the income limitation on Roth conversion. The other one, though, is I think more plausible as well, and that is the notion of restricting being able to use alternative assets, whether that's things like non-public companies like Peter Thiel did, or even some cryptocurrency, sports franchises, real estate, some of those kind of more alternative assets that today you can in fact get inside of an IRA. I think we'll probably see those perhaps change. But bottom line, expect some changes here. Certainly the Secure Act really started the ball rolling in terms of politicians looking at these retirement accounts. Last week on the program, we were talking about it being the largest wealth transfer in the history of the world happening over the next 20 years. Those are the concepts that they're really kind of looking at. So just be aware of that. The rules could certainly be changing, and you certainly want to be aware of those. And again, that's sort of the purpose of the program, is to help keep you informed on that. But we want to get some of those concepts on the table with you all today. So anyway, we're going to wrap it on up and get on out of here. Enjoy the rest of your day. This has been Dollars and Cents with your host, Joel Garris of Nelson Financial.